Welcome to MarketSnap's daily market rundown. The AI trade is getting absolutely clobbered, and a Chinese startup just lit the fuse. While everyone was watching the chip rout, a quiet rotation into financials and energy is telling a different story about where smart money is heading. Let's break it down. It was a sea of red on Friday. The S&P 500 dropped a full percent, the Dow shed nearly 0.8%, and the Nasdaq took the brunt of the damage, falling 1.4%. The VIX, our fear gauge, spiked over 12% to close near 19, confirming the anxiety is real. The Russell 2000 held up relatively well, down just 0.4%, which is a key signal we'll get to in a moment. The headline story today is the tech wreck. It wasn't just a bad day, it was a bloodbath for high-flying names. Intuitive Surgical cratered over 14% after flagging slowing procedure trends. Netflix plunged more than 7% to a two-year low after its revenue miss and a cautious outlook. Cadence Design Systems fell nearly 9.5%, and Applied Materials lost over 5.5%. Even the newly public SpaceX dropped over 5%, falling below its IPO price as a last-second Starship abort rattled sentiment. But while tech was getting hammered, there were some big winners. Travelers surged over 9% after a stellar earnings beat, proving the insurance sector has serious momentum. Seagate Technology jumped 5.5%, and energy names like Equinor and Woodside Energy rallied over 5% as oil prices spiked. This is the rotation in action. Zooming out to the weekly picture, the damage in tech is staggering. IBM is the worst performer in the S&P 500 this week, down over 26%. AST SpaceMobile lost a quarter of its value, and a slew of AI-adjacent names like Astera Labs, Marvel Technology, and ARM Holdings are all down over 18%. This isn't just a pullback, it's a full-blown sector correction. On the flip side, the week's winners are a masterclass in defensive and value rotation. PayPal surged over 23% for the week. Cintas, Thomson Reuters, and Marathon Petroleum all posted double-digit weekly gains. The message is clear. Capital is rotating out of overvalued growth and into quality, cash flow positive businesses. The catalyst for today's tech sell-off was a double-barreled blast of bad news. First, a Chinese AI startup called Moonshot released its Kimi K3 model, which it claims rivals the best from OpenAI and Anthropic. This reignited fears that the massive US capex cycle might not be as defensible as we thought. Second, oil prices surged another 3% as Iran targeted Kuwait's infrastructure, escalating the Middle East conflict. The IEA chief even warned that global energy security is at risk if the Strait of Hormuz doesn't reopen in weeks. Dan Ives was out in force today, calling the AI sell-off a gut check, not a warning sign, and insisting we're still in the third inning of the AI revolution. He's doubling down on the long-term thesis. But other analysts are pointing to overextended valuations and the risk of a cone of uncertainty for markets. The bull case is that this rotation is healthy. The bear case is that the AI trade is unwinding in a way that could drag the whole market down. On the macro front, the script is flipping. Bond yields are falling, which is a new signal that the market is starting to price in a potential economic slowdown rather than just rate hikes. Consumer sentiment actually improved to a 5-month high, but the CNBC survey shows Americans are deeply worried about their financial future and blame President Trump. This K-shaped economy is getting more pronounced by the day. Earnings season is in full swing, and next week is massive. We've got reports from heavy hitters like Philip Morris, General Mills, and Constellation Brands. But the real focus will be on the tech giants. Alphabet is already under pressure after reports that its flagship AI model is behind schedule, and Meta is reportedly in talks for a massive $10 billion compute deal with Anthropic. These earnings will be the ultimate test of the AI narrative. You can find exclusive earnings transcript summaries on MarketSnap. Looking at the sector landscape, the rotation is undeniable. Consumer defensive, consumer cyclical, and real estate were the only sectors in the green today. Financial services is also holding up incredibly well, staying extremely overbought for 24 straight trading days. On the losing side, technology is the worst performing sector this week, down over 4%. Basic materials and healthcare are also feeling the pain. The energy sector is an interesting case. It's volatile, but actually positive for the week, driven entirely by the geopolitical risk premium. That's a wrap for today's stock market summary from MarketSnap. Thanks for tuning in. This is a market that rewards patience and discipline. Don't let the fear in tech distract you from the opportunity in sectors like financials and energy. Make sure to check out our SWOT analyses for deep dives on the stocks that matter most. We'll see you back here tomorrow.